Good morning. Welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we try to help you stop overpaying taxes and start building real retirement wealth. So today we are going to answer your questions live on the air here. So this is your chance to get answers. Go ahead and type them over now, and we'll go ahead and field those questions as they come across the chat. We're also going to discuss how an S-Corp solopreneur regarding how FICA applies to solo 401k contributions. We get those questions quite a bit for those who are self-employed in a S corporation, because remember, a solo 401k plan can be sponsored by a sole proprietorship, an S corporation, a partnership, a C corporation, and even an LLC taxed as any of the above. So it's not the entity type, for example, that determines whether or not you qualify for a solo 401k. Instead, the eligibility requirements encompass the following. Number one, you cannot employ any non-owner full-time W-2 employees in your business who work 1,000 hours or more in your business. So as long as you do not employ a W-2 employee who is not an owner in your business who works 1,000 hours or more, then you would qualify to open a solo 401k plan. You can always exclude those who are under age 21, regardless of how many hours they work. What is more, you can always exclude contractors. So if you hire a contractor in your business, then it doesn't matter how many hours he or she works. You would still qualify for a solo 401k plan. Okay, looks like we have a few questions here. Let's take a look at those before we get started with today's topic. I have earned around 25,000 on Schedule C and would like to contribute 22,000. Is there any practical difference if I contribute post-tax directly to the Roth sub-account versus after-tax sub-account and then the next day transferring it to the Roth sub-account? Also, include if the 1099-R requirements change. Good question. So, one, when you make contributions to a solo 401k plan, you can make them as employee Roth solo 401k contributions, or you can choose to make them as voluntary after-tax solo 401k contributions. In your particular case, it's not going to matter whether you make them as Roth versus voluntary after-tax, because you're going to get to the same place. And that has to do with the fact that your Schedule C, line 31, earned income from self-employment activity is $25,000. So therefore, you would just make those contributions as employee Roth solo 401k contributions up to the overall limit for tax year 2026. Now, you can also contribute to the solo 401k plan for tax year 2025. That's still an option if your business is a sole proprietorship. That means you would have until April 15 of this year, so 2026, to make last year's, so tax year 2025 contributions. And that's true if you already have a solo 401k plan established, or even if you open a solo 401k plan for the first time here in 2026. When your self-employed business is taxed as a sole proprietorship resulting from Secure Act 2.0, you can now open that solo 401k plan in the current year by April 15 and make prior year employee contributions by April 15. That translates to opening the solo 401k plan here in 2016 by April 15, making the contribution, the employee contribution by April 15 for tax year 2025. Of course, this assumes you had self-employment income from your sole proprietorship in tax year 2025. So again, in your situation, since your ultimate goal is to get those employee contributions into the Roth Solo 401k bucket, then you would just go ahead and make the contribution directly to the employee Roth Solo 401k bucket, as opposed to making it to the voluntary after-tax solo 401k holding account and then subsequently converting it to the Roth Solo 401k plan. Now, as far as the contribution limits are concerned, for tax year 2025, the overall contribution limit on the employee Roth Solo 401k side is $23,500. For 2026, that increased to $24,500. As far as the Form 1099-R, if you make that employee Roth Solo 401k contribution directly to the Roth Solo 401k holding account, then a Form 1099-R does not apply. On the other hand, if you were to make that as a voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k holding account, that would result in a Form 1099-R once it gets converted to the Roth Solo 401k plan. Okay, let's see if we have some more questions. Here's the question. I would like to invest on a partial mortgage note. The money would come from two separate Roth accounts in my self-directed solo 401k. Given that the investment is coming from two separate sources, what specific record keeping do I need to maintain to be in alliance with the plan's requirements? Well, when you say two separate Roth accounts, you should only have one Roth account under that solo 401k known as a Roth designated account. Now, if you're married, or if we're talking about a business that has two owners in the business and therefore both spouses or both owners are self-employed in the same business, then that's where I can see having separate Roth Solo 401k holding accounts, because you are required to separately track each participant's funds under the solo 401k. You are required to separately track each source of funds. So assuming that you've got a two participant plan, let's say you're married and both of you are self-employed in the same business, that means that one plan, so the plan is sponsored by the self-employed business, let's say it's an S corporation. So the plan is open for the business. You and your spouse are both employees in that S corporation. Therefore, you can both participate in the same plan. You are required to have separate holding accounts, however, aka bank or brokerage accounts, to hold the solo 401k funds, also known as participant accounts. So if you both have Roth Solo 401k funds in the plan, and you both want to invest in the same mortgage note, so a promissory note secured by real estate, you generally want to make sure it's secure as a first position. So that way, in the event of default by that note borrower, the solo 401k can reconvey that property if it's in first position. When investing in notes, I would stay away from any note that's secured at second, third, and so forth position. You always want to be in first position. At the end of the day, it's your retirement money. You don't want to be playing around and making an investment that ends up losing your shirt. So if you're investing in trust deeds secured by real estate, you always want to make sure it's a first position. But to answer your question, the promissory note would actually be titled in the name of the solo 401k plan. So it's just one plan because you're both self-employed in the same business. So let's say that your name is Joe and your wife's name is Jane. So it would be Joe and Jane Smith, comma, trustee of the XYZ Solo 401k Trust. That's how the note would be titled. So then you would each send funds from your respective Roth Solo 401k holding account to the borrower, typically by wire. Now, as far as the note payments coming back, you would have the borrower do it one of two ways. One, have the borrower wire note payments directly to each respective holding account. So each separate Roth account for each participant. A second option is you can have the Roth payments on that note flow to one of the participants' Roth accounts. And then once it hits that Roth account, you can take care of it internally by moving the applicable funds in that Roth holding account to the other participants' Roth holding account. So you would do the accounting within the actual holding accounts. Those are the two most common ways that I see a note investment where you have both participants investing in the same note because they're both self-employed in the same business, and therefore it's one solo 401k plan. So yes, you can pool your funds in the same promissory note. Give me a moment here and see if we have some other questions. Here's a question. I unfortunately was not able to contribute to my accounts last year, so my accounts have been closed. Will I need new paperwork to reopen new accounts? I presume you're referring to the holding accounts for the solo 401k plan. So, especially if you use Fidelity Investments, as many of our clients do, to hold the solo 401k funds for the plan that we offer, if that's the case, then it's just a matter of reopening those Fidelity brokerage accounts. Fidelity will often close those brokerage accounts if they have a zero balance, and we can help you to reopen those again. Just go ahead and submit a support ticket on our website, and you can go to the forms tab of our website to click on the support ticket, and then we can assist you in opening up those brokerage accounts again. Okay. Here's a question here. I also have a similar situation, a previous Vanguard Roth, not sure what to do with that account in relation to your solo Roth plan. If you're saying that you have a Roth, well, Vanguard doesn't offer solo 401ks anymore. So maybe you have a Roth solo 401k with the census. If you restated your solo 401k plan from a census to our plan, we can help you to transfer that Roth solo 401k from a census to our plan. That would be known as a restatement. So that's not an issue at all. Okay. I think we're through that list of questions. Go ahead and continue to type your questions over, and we'll go over those as we go through the live stream here. So today's topic is how FICA applies to solo 401k contributions when your self-employed business is taxed as an S corporation. So let me share my screen here. Give me a moment. Hopefully you can see my screen here. So let's define what FICA is to begin with. So FICA stands for the Federal Insurance Contribution Act, which funds Social Security and Medicare. For an S corporation that sponsors a solo 401k, FICA applies only to W-2 wages. So FICA never applies to distributions. It only applies to W-2 wages from that self-employed business. So why S-Corp status matters when opening a solo 401k plan? Well, unlike sole proprietors or partnerships, S corporations must pay themselves reasonable compensation, and that's paid through a W-2 wage. So this distinction is going to directly impact how much you can contribute to a solo 401k plan, because contributions to the solo 401k plan when the self-employed business is taxed as an S corporation is going to be based on W-2 wages. And whether those contributions are subject to FICA. So this all deals with your overall payroll tax exposure. So let's break it down by the various contribution types to a solo 401k plan. You've got employee solo 401k contributions. So FICA does apply to employee solo 401k contributions. And when you make contributions to the solo 401k plan based on your S corporation, it's going to be driven by your W-2 wages, your gross W-2 wages, which is box 1. So from an employee solo 401k contribution, whether you make it as a pre-tax or as a Roth employee deferral contribution, FICA will apply. So as an S corporation owner, you can make employee contributions to your solo 401k again in the form of pre-tax or as Roth deferrals. And so again, the key concept here is that employee contributions must come from W-2 wages from your self-employed S corporation. And again, those employee contributions will be subject to FICA taxes. So why? Well, because employee deferrals are part of your compensation. FICA is calculated before retirement contributions are made. It's specifically employee contributions. Now let's talk about employer contributions. Now, employer contributions, also known as profit sharing contributions, are not subject to FICA. Those are made on the employer side, not on the employee side. So your S corporation can also make employer profit sharing contributions to your solo 401k. And that amount is going to be up to 25% of your W-2 wages. So even though those contributions are made on the employer side, you still have to have the necessary W-2 wages, box 1, to be able to support those employer profit sharing contributions. For example, let's say you receive $100,000 of W-2 wages from your self-employed S corporation. You're going to be able to contribute a profit sharing contribution of 25% of $100,000. So the 25% employer profit sharing contribution is calculated based on the box 1 gross wages of that W-2. So obviously 25% of $100,000 is $25,000. So that $25,000 contribution would be made by the employer. So on the employer side, and therefore it would get reported on the employer side tax return. So in the case of an S corporation, or an LLC tax of an S corporation for that matter, If your business makes an employer profit sharing contribution of $25,000, which again is based on $100,000 of W-2 wages, then you're going to report that employer profit sharing contribution on Form 1120, 1120S to be specific, since it's an S corporation. And if my memory serves me right, it's going to be line 17 of that Form 1120S. That's for making those employer profit sharing contributions. So effectively, it becomes a deductible business expense for the S corporation. So employer profit sharing contributions are deducted on the employer side if we're referring to an S corporation. And again, it's going to be a Form 1120S. I think it's line 17. We do have a contribution cheat sheet on our website as well that you can reference. So again, with respect to the FICA treatment, it's not going to subject that employer contribution to FICA. So it's going to be deductible to the S-Corp. So it's not going to be reported on your personal side. It's reported on the business side. That is the employer contribution. So this is one of the biggest advantages for S corporation owners using a solo 401k is being able to make that employer profit sharing contribution and not subject the contribution to FICA. Well, we oftentimes get the question, what about voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy? So here at my solo 401k financial, we do offer a solo 401k plan that allows for voluntary after-tax contributions as part of the mega backdoor Roth strategy. Not all solo 401k plans allow for the mega backdoor Roth strategy, but here at my solo 401k financial, we were actually the first in the industry to offer the mega backdoor Roth strategy all the way back in 2013. So we've processed thousands of mega backdoor Roth transactions for our clients. So voluntary after-tax solo 401k contributions are treated like employee contributions. So they are based on your W-2 wages as well. They are subject to FICA, just like employee pre-tax and employee Roth solo 401k contributions are subject to FICA. Same is true for voluntary after-tax solo 401k contributions. So that's really how it works regarding FICA. It's really that straightforward. Now, some common mistakes to avoid is trying to fund employee contributions from distributions. Remember, all contributions to a solo 401k plan where your self-employed business is taxed as an S corporation are going to be based on W-2 wages from your S corporations. So distributions do not qualify as earned income. It's not considered W-2 wages. Other common mistakes to avoid is assuming all solo 401k contributions avoid FICA. Again, only employer contributions do. All right, let's see if we have some more questions here. Give me a moment. Let's get over to the chat here. Let me get back to my slides here as well. Okay. Here's a question here. Is the IRS supposed to notify on my 1040 about employee Roth contributions, given that no 1099-R is filled out? Well, number one, a Form 1099-R never applies for contributions. A Form 1099-R only applies if you process a distribution from the solo 401k plan or if you process a conversion. Let's say you convert pre-tax solo 401k funds to the Roth solo 401k, or let's say you make voluntary after-tax solo 401k contributions and you convert those to the Roth solo 401k plan. Or if, let's say, you close your solo 401k plan and transfer it to an IRA, then a Form 1099-R would apply in those instances. But a Form 1099-R does not apply for solo 401k contributions. Now, as far as how to report contributions on your tax return, let me share a link from our website that we have a really good cheat sheet for each entity type that breaks it down. Take a look at that link right there, and let me go to that page myself now. So if your business is taxed as a sole proprietorship and you make Roth solo 401k employee contributions, then no, they do not get reported anywhere because they're not tax deductible. So if you were making an employee pre-tax solo 401k contribution, that does reduce your taxable income for the year. So therefore, you would report that on line 16 of your Schedule 1, which is an attachment to Form 1040. But because a Roth solo 401k employee contribution is not tax deductible, you do not report those anywhere on your tax return, because it does not reduce your taxable income. But the flip side is that all those Roth solo 401k gains will grow tax-free. So if you invest those Roth solo 401k funds in a lucrative investment, it's all going to grow tax-free. Okay. It looks like we don't have any other questions for now. So that's it for today's session. Thank you so much for investing your time with us. If you haven't yet, please like and subscribe so that we can keep building this community. We'll be back here again tomorrow with more content to help you make informed decisions and help you hopefully secure your retirement. Until next time, have a great rest of the day.